Happy Wednesday out there, Team 42. It's your skipper here, Darius Delta, present our macro minute for Wednesday, January 15th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is the disinflation process still intact? Our answers are the December CPI data were mixed regarding our sticky inflation theme. The core categories of headline CPI generally accelerated, while the core categories of core CPI generally decelerated. These data and other leading indicators lead us to conclude that the disinflationary process is still intact, but barely. Per our grid model projections for headline CPI and our industry-leading empirical deep dive on U.S. business cycle dynamics, U.S. inflation is unlikely to return durably to trend in the absence of a recession, which implies the highest probability outcome is inflation firming over the medium term against easing base effects. Late Q2/early Q3 is when inflation is likely to accelerate appreciably enough to cause serious problems in asset markets. Coincidentally, late Q2 and early Q3 is when we anticipate a rebuilding Treasury general account and a hawkish shift in Treasury net financing. Those dynamics are likely to render global liquidity insufficient to absorb the roughly record peak in global debt refinancing demand, thus catalyzing a global refinancing air pocket. If a stock market crash occurs this summer or sooner, we expect the dip to be bought because investors will finally find attractive valuations to bet on the AI supercycle amid tax cuts and deregulation. Brace yourselves for a wild 2025. So transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's regarding term premia. It says, hey there all, is it possible or likely that the term premia being below the historic average could return to a more normal slash expected value by short rates falling and the long end staying fairly stable from here rather than long rates increasing relatively? I ask as I try to assess and reinvestment versus duration risk at this point. So let me start by defining term premium. So this question is actually regarding the term spread, which is the spread you get in longer run securities as opposed to short dated securities. The term premia is the excess yield you get for locking up, for taking illiquidity risk on various points in the curve, as opposed to rolling over, shorter term instruments. So those are two separate things. So make sure we have our vocabulary correct. Term spread is the yield curve. Term premia is the actual excess return you get for taking illiquidity risk in the bond market. So going back to answering this question, which is again about the term spread, the question is essentially asking, could the term spread normalize to a normal level by having short rates fall? And the answer is obviously yes. Now, what would cause that, based on the current Fed's reaction function, is inflation, or sorry, is the labor market slowing faster than what they currently anticipate. They don't really want to see, as Powell indicated most recently in December, they don't really want to see the labor market get significantly looser from here. And so if it did get significantly looser from here, then they're obviously going to chase that with, falling interest rates on the short end of the curve. So now, is the labor market going to get significantly looser from here? We would argue probably not. If you look at certain leading indicators vis-a-vis corporate profit cycle or vis-a-vis some of the soft survey data, we're moving in the wrong direction if you're expecting the labor market to fall off a cliff over the medium term in the context of those two dynamics. Corporate profits are accelerating, and you also have the soft survey data are actually accelerated markedly, as evidenced by yesterday's NFIB Small Business Optimism Survey. So it's very unlikely, in our opinion, that the labor market suddenly falls off a cliff anytime soon, which ultimately suggests that the Fed is probably not going to be able to lower the policy rate much further than they've already have in the context of our sticky inflation thing, likely developing and becoming consensus, let's call it by late Q2, early Q3. So we'll wrap it up there. Darius Dell presenting our macro minute for Wednesday, January 15th, 2025. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.